$500 billion. That is what China has quietly pulled out of American debt in just the last 4 years. Not in a single dramatic sell-off, not with a press conference, not with a warning, quietly, deliberately, 1 month at a time. And the $693 billion still sitting there? That is not a sign of loyalty. That is what the exit looks like when it is not finished yet. If you have a mortgage, a savings account, or a retirement fund, stay with me for the next few minutes. Because what is happening in the global bond market right now is already inside your financial life, whether you know it or not. Drop a comment right now. Do you think China will cut its U.S. Treasury position to zero? We read every single response and we update this analysis daily. To understand why this exit matters, you have to understand why China ever bought American debt in the first place. And this is the part most financial channels get completely wrong. China did not buy U.S. Treasury bonds because it trusted Washington. It bought them because it had no choice. China runs a managed currency. The yuan is kept inside a controlled band against the dollar. Every time Chinese exports flooded into America and dollars poured back into China, the People's Bank of China had to buy those dollars to prevent the yuan from strengthening and killing Chinese export competitiveness. And those dollars had to go somewhere. For decades, the answer was U.S. Treasury bonds, the deepest, most liquid, highest-rated government debt market on Earth. At the peak in November 2013, China held $1.317 trillion in U.S. Treasuries. That was 13.4% of every foreign-held Treasury bond on the planet, the single largest sovereign position any country had ever taken in American government debt. Today, that number is $693 billion. That is a 47% reduction over 13 consecutive years, through 2 administrations, a global pandemic, multiple trade wars, and every market cycle in between. The direction has never reversed, not once, not for a single sustained period. Down, every year, every cycle, without exception. Now here is the question no one is asking loudly enough. Why did the pace of selling accelerate so dramatically after 2021? The answer traces back to a single date, February 28, 2022. That is the day the United States and its allies froze approximately $300 billion in Russian central bank reserves, assets Russia legally owned, sitting in Western financial institutions, eliminated from Russia's practical control within 72 hours of a policy decision by a foreign government. Every senior monetary official in Beijing watched that happen and ran the same calculation immediately. China holds $3.3 trillion in total foreign exchange reserves. A substantial portion was in dollar-denominated assets. The question in Beijing was not hypothetical, it was operational. If U.S.-China relations deteriorate over Taiwan, over trade, over any one of a dozen flashpoints, could Washington do to China's reserves what it did to Russia's? The answer reached in Beijing was yes, potentially. And the rational response to that answer was not panic selling. It was something more dangerous and more durable, systematic, quiet, sustained reduction, combined with an accelerating move into an asset no foreign government can freeze: gold. The People's Bank of China has now bought gold for 17 consecutive months through March 2026, adding 5 tons in March alone, bringing its total to 2,313 tons. Gold now represents approximately 9% of China's total foreign exchange reserves, up from roughly 3% a decade ago. Every percentage point of gold rising in those reserves represents dollar-denominated assets that are no longer there. This is not a coincidence. It is a declared policy direction. If this analysis is connecting dots that matter to your financial decisions, share this with one person right now who needs to understand what is actually happening in global markets. Here is where the analysis becomes genuinely complex, and where most financial commentary fails you by choosing a clean narrative over an honest one. China cannot simply dump its remaining $693 billion. The constraints are real and they matter. Aggressive selling would drive down the value of China's remaining holdings as prices fall. It would strengthen the yuan, directly damaging Chinese export competitiveness, the very thing China's entire reserve accumulation was designed to protect. It would introduce financial system instability that would hit Chinese domestic growth. Steve Hanke at Johns Hopkins has made this point explicitly. China's treasury holdings are both a weapon and a cage. But here is the shift that makes 2026 categorically different from any prior year in this story. The Congressional Research Service has confirmed that private foreign investors now account for 58.1% of all foreign treasury holdings. The era of sovereign accumulation, official sector governments buying treasuries out of geopolitical necessity and reserve management discipline, is structurally over. Private investors have filled the gap. But private investors behave differently. They are rate sensitive. They are return driven. They do not hold American debt because of reserve management obligations or geopolitical alignment. They hold it because the yield compensates them for the risk. When that calculus shifts, when U.S. fiscal credibility comes into question, as it explicitly has with Moody's downgrading American sovereign debt, the CBO projecting $23.1 trillion in cumulative deficits, and the one big, beautiful bill adding an estimated $3.4 trillion more, private investors do not hold out of loyalty. They demand higher yields, or they redirect capital. And higher yields on U.S. Treasuries translate directly, mechanically, into higher mortgage rates, higher auto loan rates, higher borrowing costs for every American household and business. The 10-year Treasury yield is sitting above 4.3% right now, despite Federal Reserve rate cuts. The 30-year fixed mortgage rate is between 6.3% and 6.83%. That is not primarily a Federal Reserve story. That is a structural demand story. The global buyer base for American debt has changed, and the price of that change is already embedded in what you pay to borrow money. The broader picture confirms the pattern is not China alone. Brazil reduced its Treasury holdings from $229 billion to $168 billion in a single year. India moved from $234 billion to $186.5 billion in the same period. Russia's holdings are essentially zero. The BRIC nations are collectively, quietly reducing their exposure to American government debt. None of them individually breaks the dollar. Together, compounding every quarter, they are raising the structural cost of American borrowing. The dollar is not collapsing. Let that be clear. The dollar still represents 56.32% of global foreign exchange reserves, more than the next four currencies combined. Total foreign holdings of U.S. Treasuries actually hit a record $9.49 trillion in February 2026. The gap left by China has been absorbed by Japan, by the United Kingdom, by European private investors. The Treasury market has cleared every auction. But absorbing China's exit required higher yields to attract the replacement buyers. And higher yields at the scale the U.S. Treasury needs, $683 billion in new borrowing in the first 6 months of 2026 alone, $249 billion more than the same period last year, is not a temporary adjustment. It is a structural repricing of American debt. A top-tier Chinese state-backed research journal published an explicit warning that China's dollar-denominated assets risk becoming, in their words, hostages, directly citing Russia's frozen reserves as the precedent. Former Chinese Central Bank Monetary Policy Committee member Yu Yongding, one of China's most influential economists, publicly endorsed further reductions specifically because of growing sanctions risk. These are not fringe voices. These are the people who brief China's monetary authorities. And what they are saying in public tells you everything about the direction of Chinese reserve management policy for the next decade. At the current pace, China's official treasury position falls below $500 billion within 2 to 3 years. Whether that $500 billion is a floor or a waypoint, Beijing is not saying. That is the uncertainty every American investor is navigating right now. The era of cheap American borrowing, underwritten by sovereign nations accumulating U.S. debt out of structural necessity, is ending, not crashing, ending, gradually, irreversibly, and at a cost already built into your mortgage rate, your borrowing costs, and the long-term fiscal arithmetic of a government that needs to sell $11 trillion in debt this year to a buyer base that is becoming every quarter more discerning about the price it demands. The $693 billion China still holds is not the story. The direction of travel for China, for Brazil, for India, for every sovereign nation quietly reassessing its dollar exposure is the story. And that direction has not changed in 13 years, not once. This analysis is updated daily because this situation moves faster than a weekly summary can track. If this gave you a clearer picture of what is actually driving your borrowing costs, share it with someone who deserves to know. Drop a comment below. What is your single biggest question about where this goes over the next 5 years? Every comment gets read. If you want this level of analysis delivered to you before the headlines catch up, subscribe. No noise, no hype, just the data, the context, and what it actually means for your money.